options trading, if you want to, say, trade Tesla, but it's way too expensive, you can do spreads. And so if you think that Tesla is going to be going up by May 21st, you can grab whatever strike you want. So if you were to buy the 710 call, that would cost you $3,585, which is a lot of money. So what you can do instead is, instead of having all of this profit potential, you can cap yourself. So you can sell, let's go $10, sell that, and now you're selling this for $3,123. So that money goes immediately back in your pocket, which covers most of this. So now you're only spending $462 instead of the $3,585, but you can only profit the $1,000 between these two strikes. So this is $10 wide. So it would have to pass, Tesla has to rise above 710, above 715, and then it has to hit 720 or 1 penny over for you to profit that full 1,000. But then you subtract this 462 that you spent. So you're really getting a little over $500 profit for spending 462. But the good thing about this is you can go pretty close to the money. You can go in the money, and it reduces your risk a lot. If you wanted to spend $400 on a contract, you would have to go up to 830, in which case the chance of you actually profiting on this is very low. You might get $50 out of it, but it would make much more sense to go closer to the money where those deltas are going to be a little bit higher. So you could do in the money, you could buy that and then sell this one here, spend $503, make $497. So, but your deltas are going to be bigger, and I mean there's more of a chance of it hitting 710 than there is of it hitting 720. So the chances of this full $1,000 getting spread out and put back into your pocket, basically, they're a lot higher. And then you can also do that on any contract you want. So this one you would spend $1,000, make $1,000, and you can move it up here to where you spend $1,383, but you can make $1,617. So you can really kind of tailor it to your risk, I would say. And then you can do the opposite as well for selling. So that was a debit spread because you're actually paying money for the spread. But if you're bearish on Tesla and you think it's going to go down, but you don't want to buy a put for $3,600, you can sell calls. So you can, let's say, sell the 715 and then buy the 730, and now you make $643 because you're selling this expensive one, you're buying this less expensive one, which caps your losses. So if Tesla were to go above 715 and above 730, this 730 call gets assigned, and you get 100 shares, and then you sell those to this person who buys the 100 shares from you. So essentially, you make $643 as long as Tesla stays beneath 715. If it goes above 715, you can lose the width of this spread, but overall it is a bearish position. So if Tesla's doing really poorly, you can just sell some covered calls, make a few $100s, and not worry about shelling out $3,600 to buy any puts. You can do the same thing with, let me clear this. You can do the same thing with puts. If you think Tesla's going to be going up, sell. You can come far out of the money to give yourself a little bit more of a cushion. Sell and buy. Make $620. So that all Tesla has to do is not go to 670 by May 21st, and you keep all $620 of that because you've immediately been paid. So you can do this on pretty much any stock that has good liquidity. You want to make sure that the spreads are tight when you go to continue. You see that's a 575 to 665 spread. That's not bad. So you can get filled anywhere between probably 600 to 630. So you'll profit between $600 and $630 depending on what you get filled at. And you can also sell, as many of those as you want. So the credit spreads and debit spreads are an excellent tool for trading options that have a higher premium, or just trading options and reducing your risk overall. Highly recommend doing credit spreads for earnings, because earnings have extremely high implied volatility, which makes the contracts more expensive. So you could sell puts that are pretty far out of the money. Then Tesla has earnings and they go up. And so now the IV just dies on this. So instead of being $1,700, it drops down to, $1,000. But because you sold this, you get to buy it back at $1,000 and keep the $725 profit between the two. So there's a lot of different scenarios in which you can use selling premium. So credit spreads and just selling options can benefit you in more ways than just buying an option and hoping the stock moves in the direction that you bought the option for. So if that's interesting, I can always make more videos on that.